Let's focus then to some market trends now. Now, in 2023 so far, promoters have sold close to around $10 billion. That's in this calendar year so far, and we still have 4 months to go. Now, that compares with close to around half that amount in the past year. Last week as well, there was big promoter selling in the likes of Adani Power, JSW Energy, and Interglobe Aviation. To discuss more about these trends, well, we're joined by Mr. V. Jayasankar, the Managing Director and member of the board at Kotak Investment. Hi, sir. Morning. Thanks so much for joining in. Well, two ways of looking at it, right? One would be, hey, the promoters are selling big time. The other way would be, look at the depth in the Indian markets. You have $10 billion of sale from the promoter entities, and yet, in fact, it's all being absorbed and lapped up pretty easily that way. What's your comment on this? Which side are you leaning towards?
So I would put it this way. The domestic flows have been very strong over the last couple of years between the mutual funds and insurance companies. In each of the last two fiscals, that's 22 and 23, you have had about nearly $30 billion of money come in, right? And the FPI flows in the current year have been positive of about 19 billion, while it's been negative in the previous 2 years. So when you look at the domestic and foreign flows being equally positive, between them, probably in the current year, FPI flows about 19 billion, domestic flows must be 10 plus billion. So you have had about $30 billion of money coming into the market, all because of the India growth factor being recognized globally, and also investors in the Indian market, the domestic investors making not only good money, but also being very sensible about long-term investment through SIPs. So I would say it's driven primarily by a great deal of stability in the current year between both the domestic and the foreign flows. For the first time in the last 3 years, both are positive and quite attractive. And obviously, when you have these kind of flows, you need more paper. Otherwise, you obviously will have an asset bubble. And I think it's in this context, you should see a $10 billion of blocks. You'll also see about $10 billion of IPOs, maybe another $3 to $5 billion of follow-on. And to have this kind of a pipeline and a deal flow of about, call it $20, $25 billion is very healthy to absorb, call it $20, $25 billion of fresh flow. I would put it as the flows. The second factor I would say is the blocks have been quite prevalent, I would say, in the last 2 years. Even when the markets were down last year, we had in the last calendar year something like $7 to $8 billion of blocks. For example, you had Max Healthcare, KKR sell down $2 billion in the previous year. Similarly, you had others really taking out some money, both private equity investors as well as promoters. So the monetization of blocks has probably heightened the current year, but it was quite prevalent and prominent even the last year. And I think the blocks business will continue to see a good momentum for the next couple of years.
Hi, Jayasankar, and you were involved in that Max transaction as well. Prashant here. No, so flows, as you explained it very well. But on the other side, which is the fact that these are early investors and promoters themselves who are selling, what does that tell you? I mean, is there a signal to take, even if it is very broad signal and can't kind of very specifically pinpoint and say that, well, this is what it exactly means, but is there a broad signal we can take about where they think valuations are vis-a-vis where they see opportunity, at least in the medium term?
Prashant, not necessary. I will tell you why. You should look at the block pipeline more in the context of how active the primary markets have been the last 3 years. So if you look at post-COVID, we had a number of issuances over the last 3 years, in particular in the calendar year 21. And you're seeing the private equity investors and promoters in those situations kind of monetizing. And to give you an example, for MPS compliance, Lodha had to do 7,500 crores of QIP over 2 transactions. Also, we had Manyavar doing a block of about 3,000 crore just a few months back. So MPS compliance forces a lot of promoters sometimes to really monetize and create the 25% minimum public float. In other instances, private equity investors who are holding significant minority stakes in companies, whether it's in Medanta, whether it's in Kim's Hospital, whether it's in Sona Comstar, you would see a number of issuances that have happened, 100 odd issuances in the last 3 years. There are private equity investors sitting with fairly large stakes. So it's only natural that you would see a fairly good block pipeline. The one thing that I would probably kind of highlight is in the current year, you have had more of the small cap and mid cap IPOs happening. So therefore, you will not see large blocks from the vintage of calendar 23, unlike 21 and 22, when you had large IPOs hitting the market. So it's also a function of what kind of size, what kind of market cap companies have when they hit the capital market. And I would say whatever blocks you've seen last year and this year is because of tech companies going public. For example, the digital tech companies probably have contributed more than $1.5 billion of flows right in the secondary market in the last 6 to 9 months, ever since they came out of lockup. You're seeing a lot of hospital companies getting listed, a lot of hospital companies, both the promoters and private equity investors, creating that MPS requirement.
Jayasankar?
And therefore it is across multiple sectors.
Sure. Jayasankar, just one final question from my end. This is Sonia here. I get your point that it's very case by case and all of that. But if you look at the number, right? I mean, 80,000 crores of selling by promoters this year in FY23 is far higher than what we've seen in the last 5-6 years on an average. And generally, insider selling is considered to be sort of a red flag, at least for shareholders, investors, stakeholders. Is that the right way to look at it? Should investors be concerned with the kind of promoter selling spree that we're having?
Sonia, not at all. And I'll tell you why. I mean, if you look at Interglobe, for example, one of the promoters is selling out of a very planned exercise, which is quite public, right? If you look at Mahindra CIE, Mahindras have exited CIE. It was a good partnership between Mahindra and CIE that lasted several years. And now it's no longer a strategic position for Mahindra, so they have exited. If you look at Manyavar or Lodha that did listings where the promoters either did a primary or secondary block to create the MPS compliance, it's more to do with SEBI compliance. So I think it's all driven by either a P investor wanting an exit over a 3 to 5 year period, which is fair because the normal period for a P investor is 3 to 5 years. And when the markets are at its robustness, why not? And that's the right time to kind of sell because the outlook is also pretty exciting for the incoming investors. And therefore, both for the exiting investor as well as the incoming public market investors, it holds a promise. And as far as promoters are concerned, you have to look at the context. And in India, with promoters getting comfortable about giving up control, or when there are multiple promoters, one of the promoter continue to be the surviving entity, I think it's very, very likely that you'll see more of these transactions. So I think you should take it as a trend. And when the markets are robust, that's the right time for any block sale.
Okay, all right. Thank you so much, Mr. Jayasankar, for stopping by and giving us your comment. You know, when I put out this piece, the question that we were asking is, who's getting it right? Promoters or investors? Well, as you're clearly telling us, there's no need to worry from an investor perspective. This is part of the trend, some money being taken off the table. Maybe, in fact, it's, as of now, no need to really worry. But